Hey, Axia members, welcome. This is Brannigan Barrett. This is the stream for Tuesday, the 17th of March. So this is our usual objectives for the stream, and as usual, we're going to start off with the Q&A from today. Now, where we're going today is we're actually going to go with key auction reversals. It's a strategy that's been dealt with in both the market profiling course as well as the footprint tool course. So it's a strategy that's one and the same. It doesn't matter what tool you're using to execute it with or to observe it with. And the important thing to obviously understand about this trade strategy is a little bit of context is required, and you are going to need to be quite aggressive in terms of execution. And it's also very much a counter trend strategy. Now, why I like the strategy for this week is because with all the volatility we've seen, these key auction reversals become particularly lucrative in the current conditions. So if you know what you're looking for, and you kind of in the right frame of mind and you switched on to it, you can capture 2-3% moves in some of the markets when these key auction reversals present themselves. So that's where we're going now. The best place to start with the key auction reversal is exactly what it is. So note the first word. It's called a key. In other words, it's key. It's important. It's an auction process. Okay. As well as it's a reversal process. So there's three key elements for it. It's not just called a key auction reversal for fun. It's key because it's extremely relevant. In other words, when we have a key auction reversal, it tends to mark out a big turning point in the market that tends to hold for some time. It is also obviously a reversal of the market, and it is an auction process, okay? And it's the auction process that ultimately defines whether something is a key auction reversal or not. Okay, now I'm going to explain this to you little bit by little bit. We'll go through some of the key principles of it, and then we can show you another example of it. Now, what you're looking at here is Bitcoin. All right, so this is BTC. It's pretty neat and nifty that we got one of these in Bitcoin this week because some people do trade Bitcoin. Okay, every product can be traded. The strategies are relevant regardless of the market. Okay, what's important is the auction process. That's ultimately how you define a strategy. Now, what we saw in Bitcoin was initially quite an aggressive sell-off. So we had this very aggressive sell-off from 6,000 all the way down to 4,000. Okay, and what we can see if we put a volume chart up here, we can see an acceleration of volume. In other words, more and more activity going through the market. Now, volume is key to a key auction reversal. Why? A key auction reversal is ultimately created by large time frame participants. Okay, it's not created by algorithms. Obviously, the algorithms pick up on these big positions coming into the market and they front run them. But ultimately, it's created by one big position obviously gets out of the market, followed by another big position that gets straight back into the market. Okay, and that's kind of how you have to think of a key auction reversal. It's where we get initiative from the sellers initially, followed by initiative from the buyers, and that's the key. If you go through the footprint course, you'll hear me talk about this concept of initiative often. And if I look at all of the trading principles and strategies that I utilize, initiative tends to form almost the backbone of a lot of those strategies. Is understanding what initiative is and what it represents. So it's initiative followed by initiative, and that's important because what it tells us it tells us this price point where the market ultimately stops becomes very crucial, almost discount. Think of it as a discount price in the market, and we know it's a discount price because of the speed at which the market reversed. Okay, that's the key to it. A key auction reversal is not, a market that goes down and then slowly grinds its way back up. No, it's initiative. In other words, very aggressive, very fast-paced to the downside, high volume, high volatility, followed by the exact same equal and opposite, high volume, high volatility, swift reversal. Okay, and it creates that what we call a symmetrical type of V. Not something like this where you have one and then you have something like that and something like that. Okay, that's not a V-shape reversal. Okay, V-shape reversal or key auction reversal is where we get an auction to the downside that's aggressive followed by a very aggressive auction to the upside. Okay, now the basic premise of how this pattern works when you get a key auction reversal. A lot of day traders with the help of the price ladder will recognize the price action. Okay, so you can use a price ladder to pick up on these key auction reversals and you can tend to get in very aggressively. So very aggressive prices. However, not everyone is, price ladder orientated. Not everyone has developed the skills of the price ladder. It doesn't mean the strategy isn't relevant. Okay. Now, how this works in a basic rule of thumb, and again, you can go through this in the footprint course or the market profiling course. It's dealt with extensively there. But what you're looking at is you're looking for a consolidation phase to occur. So initially, you get the aggressive selling, followed by the aggressive buying, okay, followed by what we call the secondary positioning. Okay, secondary positioning, in other words, we have shorts, fresh shorts entering at the start of the V, and we have very aggressive longs that are entering higher up. Okay, and this is key because it's the higher up buying activity and auctioning that confirms to us how important that low is. Okay, we should not, in a key auction reversal, you should not be revisiting the low, not even close to the low. Okay, if we're revisiting the low, it's telling us this concept of a discount low is false. Okay, the fact that we don't revisit that low tells us how significant that low in the market is. And what we get then is we get a little bit of a consolidation phase, in other words, a positioning building phase, before we then get the break and continuation higher. Okay, so the way I tend to play this, okay, obviously I'm a day trader, so I will be initiating, I will be partaking in that up move. Once that sort of fizzles its way out, I'm looking to be a buyer on a dip. Okay. Now, where it dips to, that you're going to need to rely on some of your other tools, whether it's a footprint, a market profile, whatever it might be. Where it dips to, that's anyone's guess. Okay, but the important thing is you need to be getting in on a dip and not being too aggressive on the highs. Okay. Yes, it is definitely fine to sell this first time because very often you're going to get a lot of two-way trade before you get the continuation. Okay. Now, what we're looking to do ultimately is we're looking to just build a position on the long side, eventually looking for the market to break towards the upside. Now, what I would say as a target is you're looking for the size of this range. Again, rule of thumb, size of this range, which is roughly speaking $1,000. Okay, we're looking for the size of this to the upside. Okay, so we're looking for, roughly speaking, a target of 6,600, somewhere around there in Bitcoin over the course of the next couple of days. Okay, that's a V-shaped reversal. Very basic. We first have to learn to identify it with the V, with the symmetry, with the same velocity, same volatility to the downside as we see to the upside. We then look to initiate on a dip with the buy. Once we've got our long, we're looking for a break above the top of this little consolidation pattern for a move at least the same size of this range. Okay. Now, this is pretty much all the little examples I wanted to show you, or all the sort of principles I want to talk to you, is risk reward, price discovery, volatility, and risk management. Now, I'm going to take you through a second example, and I'm going to take you through this in the US 10-year, and I'm going to show you, or just kind of talk a little bit about these concepts of how you manage risk, the risk reward, etc., etc. Okay, so the second example you're looking at now is the US 10-year. Okay, this happened over the course of this week. This is now a daily chart. Right, and we're also exhibiting a V-shaped reversal in the 10-year. Right, so as quickly as we've moved down in 3 days, we've then retraced that in 1, 2, 3, 4 days. Okay, so we've got a bit of symmetry on our V. Now, like I said to you, it's okay for us to initially sell at the top here and look for a sideways consolidation pattern to occur. Right, so very early next week, don't be surprised if you see the US 10-year come all the way back down to 70 basis points and start to move a little bit sideways. Okay, and ultimately we're eventually looking for that move higher, to continue correcting itself effectively. Now, the important thing is we're looking for volatility. Okay, V-shaped reversals are not, they don't occur, in random spots. They occur firstly when the market is in price discovery mode. In other words, price discovery simply means that the market hasn't traded in these areas. It's trying to find that area of buying. Okay. Now, obviously, if you've been following the US 10-year, you would know we are making record low US 10-year yields this year, and the market's been trying to find those buyers, and it eventually found them around the 33 basis point mark. Okay, so the market tends to always start, a V-shaped reversal has to come from price discovery. Okay, so when markets move into these uncharted levels or untraded areas, that's when the V-shaped reversal potentially is on. Okay, so first you need price discovery. Second, you need volatility. So it needs to be volatile, it needs to be aggressive. Market needs to be aggressively moving one way, aggressively then moving the other way. Now, risk reward speaks for itself. Okay, because we're entering in on a dip, on a pullback, right, we're allowing ourselves exposure. Okay, take for example, if we're looking for a range move to the upside, we're allowing ourselves potentially that much opportunity, and it's only going to cost us that much. Okay, so we're looking for a 2-to-1 type relationship where we're getting 2 times the reward, 1 times the loss. Now, you are in good V-shaped reversals, you're going to experience very little heat. Okay, it's very rare to go offside. So once the market actually takes out that top end of the consolidation range, you do tend to be able to trail your stop, and you should be trailing your stop. All right, so it's a very, very good percentage type play, these V-shaped reversals. And then the most important thing is the significance of these V-shaped reversals. They tend to flag big important areas in the market. In other words, there's a high probability we maybe never ever revisit this 33 basis points. Now, again, I know that's going completely counter to everything fundamental you might have heard, which is that we're going to zero interest rates, we're going in a QE, the coronavirus is going to destroy the world. Okay, that's fine, that's fair enough, I can understand that logic. The important thing is that when you learn to strategize, you strategize based on what the highest probability outcome is. Okay, in other words, it's not guaranteed to not retest that, but it is a high probability that we're not likely to test or come close to testing this level for a number of weeks and months and potentially even forever. Okay, so that's the important aspect. That's why we talk in probabilities rather than certainties. Okay, so that's the V-shaped reversal then in the Bitcoin and the T-note. Now, I got a question this week from one of the members, and that was the question there. What is your opinion on the importance of unfinished auctions at tops and or bottoms of footprint bars? Okay, so the footprint is obviously a tool, and to sort of make this a more generic explanation or a principle, I'm actually going to show to you what an imbalance looks like on a candlestick, and obviously you can relate that to the footprint, you can relate to the market profile, you can relate it to whatever tool you want. Okay, the concept and the principle is one and the same.